the market, let's just take a quick look at that. It's still down, you'd have to say. There's no recovery that's come through in the Nifty at the moment, down almost about 200 odd points. But there are plenty of stocks that are picking up pace as well. So look at something like a Cochin Shipyard, up almost about 8 odd % right now. A lot of PSU companies are coming back. LIC, by the way, that one is above its IPO price of 904. So LIC is something that we're looking at this morning, 907 now on that stock. And then something like an Intellect Design Arena is also up about 1 odd %. ICICI Lombard, just get that stock up for you on board. The net earned premium this time around for ICICI Lombard has gone up 13.5% at little over 4,300 crores. And that stock is up almost about 4 odd % reacting to that. The underwriting losses have reduced as well, about 4 odd %, coming in at 282 crores. So in general, the numbers were not too bad and the stock is up and about. If you look at the premium growth as well, the gross premiums for ICICI Lombard have gone up almost about 4 odd %. So volumes are picking up, price action has been good on that particular stock. More on that in greater detail in a bit. But just a couple of more details. All right, we'll get the management. Gopal Balachandran, who's the CFO and Chief Risk Officer of ICICI Lombard, is with us. Gopal, Happy New Year and thank you for joining us on CNBC TV18. First, if you can tell us a little bit about the premium growth that you're expecting. You know, the net earned premium this time was not bad at all, 14% growth year on year. What can we expect as we move along? And in FY25, do you think there's a chance that you could move above this band of 13 to 15% in terms of net premium growth?
So good morning, Sonia, and season's greetings to you and everyone else to the channel and the viewers here. So I think when you look at growth, it has to be looked at in the context of how you see the market momentum play out. As I have been kind of talking through even in the past, this market has always exhibited growth. Again, if you look at historical 15-year track record, the market has grown at about 15% or thereabout. So even for the current 9 months, the industry has grown at about 14% for the 9-month period. And within that, ICICI Lombard has grown at almost about 16.5%. So this is something that we have always maintained. Whenever we see the market getting a bit sensible, we have always tried to have at least 100 to 200 basis point outperformance in terms of overall growth numbers. And that's something that we are sticking to even as we head into FY25. The momentum across segments looks to be very, very positive. Whether you look at motor, health, commercial lines, activity seems to be buzzing a lot. And therefore, as we head even into FY25, as I said, momentum looks very, very strong. And given the opportunity that the market presents, we should continue to exhibit, let's say, 100 to 200 basis point alpha over the market growth numbers.
The last time you were a bit cautious in the motor segment because of the unsustainable underwriting. And now you're saying motor has improved. Can you give us an outlook on what that segment could look like?
So again, from an ICICI Lombard standpoint, when you look at across segments, and I'll specifically address the motor part that you raised, in general, I think the theme that we have largely advocated is profitable growth. As in to say that wherever we see opportunities coming back, then obviously we have been able to leverage on our various strengths that we have in terms of distribution, service, and technology. Last couple of years, motor as a segment had seen elevated levels of competitive intensity play out. When you look at the first half numbers, which is available at a quarter's lag for the overall market, the combined ratio of that segment for the industry as a whole has kind of improved by about 4 percentage points. So there seems to be some kind of improvement that the market is starting to exhibit. And in this context is where, when you look at it from an ICICI Lombard standpoint, I think we are seeing renewed growth momentum opportunities for us. In fact, in the last couple of years, we have been underperforming the market on motor as a segment. But if you look at for the month of December, the industry grew at roughly at about 9% or thereabout. We grew at almost close to about 11%. So we actually kind of again outperformed on motor as a category. And which is where I think as we now look forward, we believe that the semblance that the market seems to kind of exhibit on this segment, we believe there's a great opportunity for us to ride the growth on motor as a category. Even if you look at motor vehicle sales across private car, across two-wheeler and even commercial vehicles, largely maybe due to festive demand, rural demand getting picked up. In general, I think the sentiment of growth in volumes also kind of is paying out to our advantage. And that's why as a category, we are very, very positive and we're rightly poised to capture the opportunity for growth in that segment.
Got that. Good morning, Mr. Balachandran. It's always a pleasure having you here. Prashant this side. So you have a new leader. Mr. Mantri has come on top as the CEO, MD. What's the big kind of message down? I mean, what's the sort of one or two things which he's very focused on and what he'd like to execute?
So, Prashant, again, good morning to you. The good part is Sanjeev has been a part of ICICI Lombard. So hence, in that sense, he has been with the organization for the last 8 years. He joined us in 2015, of course, being with the ICICI group for a very, very long period of time. In terms of the point that you kind of talked about as to what is it that we would want to kind of focus on, given that he has now assumed the position at the top, I think the thought process of underwriting in terms of driving profitable growth as a theme, that pretty much continues as an institution. So therefore, even from Sanjeev's standpoint, we will continue to kind of drive profitable growth as a theme across the organization. What we will obviously also try to significantly focus on insofar as Sanjeev is concerned, I think we have created various pockets of functional excellences. We will obviously want to kind of expand that and make sure that we're able to create a lot more organizational excellence initiatives. And in that context is where, even from an industry standpoint, there is a lot of value pools that we can kind of focus on. And therefore, in the process, drive the theme that I spoke about in terms of profitable growth that we want to achieve.
All right. Hi, Gopal. Good morning, and thanks so much for joining in. Could you give us a number? What kind of industry growth are you factoring in? Point number one. And point number two, the combined ratio, I think it's holding around that 103.6. You have been telling us it'll come down to around 102%. Do you stick to that by 2025? And also, what's the trajectory post that?
So, Nigel, again, good morning to you. So, again, if you look at which is what I just mentioned earlier, if you look at this industry over the last 15 years, it has kind of grown at a compounded rate of almost close to between 15 and 16%. And given the market opportunity that it presents, there is no reason why this market should not continue to exhibit growth around those levels in the range of 15 to 20%. So as we kind of head into even, let's say, FY25, that's what we would be kind of penciling in, depending on how we see different segments play out. As I said, insofar as ICICI Lombard is concerned, I think we would want to kind of continue to maintain that alpha of 100 to 200 basis point over market growth numbers, given the strengths that we have in terms of distribution, service, and technology. So that's what we would kind of drive insofar as the top line objective is concerned. On your point on combined ratios, pretty much what we have talked to the market is to try and get to a combined ratio of 102% by end of FY25. Now that thought process continues as we speak. Obviously, this has to be looked at in the context of where the market is operating at. So for example, if you look at the industry combined ratios, which is available at a lag of a quarter, industry combined ratios are operating at about 112. This number, if you would have looked at first half of last year, that number was about 116%. So there seems to be some kind of an improvement in the overall industry combined. And if the industry improves further from here on, then to that extent, obviously, we would also kind of want to recalibrate the 102% objective that we have set for ourselves by end of FY25. But as of now, we're kind of sticking to the guidance that we have talked about to get down to 102 by end of FY25.
Okay, all right, got it. The regulators formed a committee to de-tariff regulated business segments. Can you confirm if this will bring the motor third-party deregulation under discussion? If yes, would you support this? And if it's done, in your understanding, would it increase or decrease the motor third-party premium?
So I think if you look at motor as a segment, currently the way it is structured is there are two components of the risk that we underwrite. One is the damage to the vehicle, which gets kind of covered as a part of the own damage premium. And the other one is the segment that you refer to, which is the motor third party. Motor third party at this point of time has been under tariff, which means there's a stipulated price that kind of gets put out for writing the risk at every year. As you rightly indicated, there has been a committee which has been set up to look at possible deregulation of motor third party segment. So obviously we'll wait for the report of the working group to play out. But if you look at in general, the long-term trajectory that even the regulator would be looking at is to try to significantly free up the market and get to market pricing. So while deregulation of third party could also maybe result into, let's say, a reduction in prices, but at the same time, what one could also expect is a much better pricing that could come through on the own damage segment as well.
Right.
So on balance, I think motor as a segment is something that is likely to exhibit better, as I said, growth momentum, including pricing as one of the factors that one would kind of watch for. The other thing to look at in the context of third party is the claim compensation is basically out of court awards. Now there, definitely what we are seeing is clearly an increase in the average claims payout
Right.
that we have to pay out to a victim who is impacted by the third party incident. Now, those compensations are clearly seeing an increase in the average claim sizes. So, therefore,
Okay.
any action on pricing has to be looked at in the context of the claims experience. And
Right.
as I said, also look at the overall pricing of the entire motor portfolio. So, obviously, we'll wait for the report to come out. But I believe long term, again, this is very, very structurally very, very positive.
Right.
What effect does pricing do will be a function of, as I said, the loss experience as well.
Mr. Balakrishnan, we take that point. Thank you very much for joining us, and we hope that for the next quarter we'll see you and Mr. Mantri both join us for the quarterly interaction and other interactions as well. Thank you very much for taking out the time and being with us here on CNBC TV18. Digant Hari.